What is an S&P 500 index fund? In this video, we're going to take a deep dive and show you all the details. Okay, we're going to start here on Morningstar.com. I'm going to type in a ticker for an S&P 500 index fund. This one is Vanguard's ETF version, and the ticker symbol is VOO. SPY is a popular S&P 500 index fund as well. They're both very similar. Fidelity has one. Everyone pretty much has one. So if you look here on Morningstar, it'll give you a quote. It'll tell you the expense ratio. So this is very important. You want as low as possible. 0.03% is very low. I think Fidelity does have some zero expense ratio index funds now. But the big advantage of index funds are their low expenses. So if you look at an actively managed fund, those fees can be 0.5%, 0.7%, 1%. Just depends on the fund, and that really hurts your returns. So that's a major advantage of index funds. You can see the category, they call it a US fund, right? US stocks, large blend. So the large means large market capitalization companies. There's large, medium, and small. I think there's also like a micro, but generally S&P is the top of the US stock market. So it's the largest companies by market cap or market capitalization, meaning the value of those stocks. So you look over here, another advantage of index funds, the turnover. So I believe that's how many stocks that come in and out of the fund in a year is only 2%, which is very low. If you look at actively managed funds, it'll be much higher, and that hurts you in cost and also taxes if you hold this in a taxable account. So I'm going to look over here at performance. So we talk a lot about this on the channel. The S&P 500 has done very well. So the past 10 years or so, $10,000 would have turned into over $40,000. So another thing you can look at when you're looking at a fund here on Morningstar, you can click on distributions. So most index funds, probably all, pay some dividends. So a dividend is paid by some companies. Not all companies pay a dividend, but the ones that do and that are in this index will be reflected here. So that is basically income that you will receive, and you can have this set up to automatically reinvest in the fund. That's kind of the default. But if you're living off a portfolio, you can choose to take those dividends and spend them. And so you'll see year to year, it'll tell you how much this fund has paid out. So 2021, you see it's green for income, $5.44. 2022, $5.95. 2023, $6.36. 2024, $6.70. And 2025, $7.07. So that's the good thing about dividends. They do grow. As companies grow their earnings, they tend to pay and raise those dividends. But remember, those dollar amounts are on the share price basis of, what was it, $635. So the actual dividend yield on the S&P 500 right now is pretty low historically for the S&P. It's only 1.11%, but it's something. And those dividends reinvested do increase your share count if you're still not spending them. So that is a benefit. If we look over here at the portfolio, so you can see here, it breaks down the class of equities. It tells you some statistics of the group of stocks you own, right? So these are the 500 largest companies in America. PE ratio, price to earnings. Here's that dividend yield. Depending on if it's forward or back looking, this is probably forward looking. It's a little bit higher, 1.24%. historical earnings growth for these companies, etc. And then you can see here it breaks down the sectors. So how much of this fund is in each sector? So basic materials, pretty low, 1.65%. Let's see, financial services, a little bit higher, 13%. Communication services, almost 11%. And of course, technology is a big part of the S&P, 35%. And that's just a fact of the technology companies like Apple and Meta and Google. These companies are dominant and make up a big part of the index. You can see here 504 equity holdings. It's a S&P 500, but some companies have different share classes. Like Alphabet, for example, has a few, Berkshire Hathaway, and so that's why it's a few more than 500. So you can see here the holdings, and this is as of the end of the year 2025, December 31st. So Nvidia, which has had quite a run, now makes up almost 8% of the S&P 500. And then you can see over here the 1-year return, 44%. So it's done really well. Apple is almost 7%. 1-year return is almost 20%. Microsoft, 6%-ish. Negative almost 3% for Microsoft. But this is the great thing about an index, right? So you have your winners are climbing to the top. All these companies have historically done really well. Some years they won't do as well, but other companies make up for it. For example, Alphabet had a great year, almost 69%. So that's what you own when you own the S&P 500. And the beauty is, out of these companies, the great ones will rise to the top, and the losers will fall off and actually fall off the index. Okay, so here's another view of the S&P 500, and this website, which I'll link below, is called Finviz, and it gives you a nice visualization of the companies. So this is a one-day view, so this is how the companies did on Friday. And so, but the size of the squares indicates how large the company is in market cap. Right? So over here you have this large square that is all of the technology sector. And you can see right now Nvidia is the largest percentage of that. Had a great day on Friday. But this is a cool thing. So you see Nvidia, Apple, Microsoft, which is a software. Right here, Apple tells you consumer electronics. Oracle, Palantir. Some over here, some of the chip stocks, other chip stocks, Qualcomm, Avgo, which I believe is Broadcom. So yeah, just gives you a nice view. You can see all these different companies, Cisco, squares get smaller, IBM. So that's technology sector. Consumer cyclical, you can see Amazon, Tesla, pretty large part of it. Down here, communication services, Google, obviously a large part, I think almost 6% of the index now. Meta, a little bit smaller. Consumer defensive, you have Walmart, Costco, Coca-Cola, Pepsi, Procter & Gamble. Industrials, you have GE, not sure, some of these others, Caterpillar. So yeah, real estate, pretty small sector. Utilities, also pretty small. Down here you have healthcare, Eli Lilly, Johnson & Johnson, Abbott, United Health, CVS. And then you come over here, you have this is the financial section, JP Morgan, Visa, American Express, Berkshire Hathaway, asset management, you got BlackRock, insurance, banks. So yeah, it just gives you a real view of, I'll move my cursor, a real view of the S&P and all of these great companies that you own. I forgot Netflix over here. So yeah, just a view, and it shows you by the size of those squares how dominant those companies are and their previous day performance. You can even go over here and select, let's see. Oops. Let's go 1 year. There you go. So you can get a 1 year performance view, right? So you can see there, we talked about this before, Microsoft is down 3%, Apple is up almost 20, Nvidia is up almost 50%, Google 67. So yeah, it's a nice view if you want to just look around and see which stocks have done well and which haven't. So okay, so here is a paper I downloaded from the SPGlobal website. So the S&P Global defined the S&P 500 index as well as other indices. And so you can see here they give you a good paper that defines what it is. So S&P is widely regarded as the single best gauge for U.S. large cap equities. So 500 companies covers approximately 80% of the available market capitalization, meaning 80% of the U.S. stock market. So the other 20% of the value of the U.S. stock market is in the mid caps, small caps, micro caps. So by this, you own most of the U.S. market and definitely the larger companies. All right. So it just has a few interesting things here. So in order to be included in the S&P 500, obviously you must be a U.S. company. You must have a market cap of 22.7 billion or greater. And then there's things about float here. Financial viability. I like this. Companies must have positive as reported earnings over the most recent quarter, as well as over the most recent 4 quarters, summed together. So basically, companies that actually have positive earnings and not in the early stages where they don't earn any money yet. Some things about liquidization, sector balance. So that's considered. Company types, all eligible U.S. company exchanges can be included. REITs are also eligible. Okay, so here's one more interesting site. So this site is generally, it's called Multpl, generally known for the Shiller PE ratio, which I'll show you in a minute. Right now I'm on the tab that is the S&P 500 earnings growth rate. So when you own these stocks, it's nice to know that the value is going up, but also the earnings of these companies are going up, right? So the current earnings growth rate of the S&P is 13.58%. So it's a pretty healthy growth rate, and that's reflected in the growth of the share prices, right? But it's interesting, you can see in different times, those growth rates go negative. 2022 is a tough market. Obviously, COVID, we had negative 32%, but then the earnings shot right back up, right? Look at that, 110% earnings growth rate. The financial crisis over here in 2008, 2009, negative 90% with the earnings. So anyway, as you own this, it can give you a feel good that the price is going up, but so are the earnings. There's a reason for that. The Shiller PE, a lot of people try to time the market. I was guilty of this. So this is it's looking back 10 years, I believe, with the average earnings, to look at this cyclically adjusted PE ratio, I believe they call it. So anyway, we're pretty high right now. We're at 40. It's, as you can see, .com, we're up to 43 or something, and then the bubble burst. So it gives a lot of people an uneasy feeling right now. But you can look at 2021, we were up to 38, 39. And then it ended up coming back down, and the stock market has done great since, since that time. So it's not a great timing tool, but the market is certainly overvalued a little bit right now, or it could be a lot. It's hard to tell. But anyway, I just dollar cost average, keep buying, and you'll end up paying a fair price. So let's see a few other views here. S&P 500 dividend yield. So you can see this keeps going down. So the price of the stocks are high, the yield is low. That's not always a great sign. So another data point that market is definitely flying a little high right now. So this is the earnings for the S&P overall. So if you think of the price of the S&P at almost 7,000, the earnings are 233, which that'll give you that PE ratio. But the interesting thing you want to look at here is look how the earnings grow over time, right? They just keep growing, aside from the major dips of those crashes. Let's see. And here's your historical prices, right? So this is at 69.63, according to this website. Yeah, Friday, February 6th. So anyway, it's an interesting website to play around with, and gives you some more data points to look at. If you want to see the best savings accounts of 2026, just click here. Thanks so much for watching. Please subscribe if you haven't, and I'll see you in the next video.